The effects of portfolio size and holding periods. Narasimhan Jagadish and Sheridan Titman followed up their 1993 paper in 2000 and one with Profitability of Momentum Strategies, an evaluation of alternative explanations. It highlighted the effect of portfolio construction on momentum, particularly intermediate-term momentum. Wesley Gray and Jack Vogel also examined the 500 largest cap stocks from 1927 to 2014. In their experiment, they varied the portfolio size from 50 to 300 stocks and the holding periods from 1 to 12 months. The returns considered were gross of fees and included reinvestment of distributions, such as dividends. The table shown here lists the compound annual growth rates of value-weighted portfolios for varying holding periods and portfolio sizes. The portfolio sizes, number of stocks, are arranged horizontally and holding periods, in months, vertically in ascending order. The experiment revealed a clear trend. Shorter holding periods and fewer stocks deliver higher annual growth rates. The portfolio with the highest growth rate is highly concentrated and rebalanced monthly. Yet you might ask, does monthly rebalancing increase trading costs, diminishing momentum returns? To answer, we can consider a portfolio with 50 stocks that is rebalanced after every 3 months instead. According to the table above, this concentrated, quarterly rebalanced portfolio has annual growth rates of 15.15% over 1927 to 2014. The momentum portfolio loses a substantial amount of return, but has a much lower transaction cost. If the transaction costs are known, investors can determine the trade-off between higher returns from a monthly rebalanced portfolio and the lower trading costs of a quarterly rebalanced portfolio. To illustrate this point further, the authors considered a semi-annually rebalanced 200-stock portfolio, which they called a diversified portfolio. The difference in return compared with a more concentrated, more frequently rebalanced portfolio becomes even more glaring. The annual growth rates falls from 15.15 for a 50-stock, quarterly rebalanced portfolio to only 11.88%. Assuming the all-in trading cost to be 0.5% per rebalancing, the returns of the diversified portfolio reduce from 11.88% to 10.88%. Meanwhile, the returns of the 50-stock, quarterly rebalanced portfolio fall from 15.15% to 13.15%. The return of a concentrated, quarterly rebalanced portfolio is still 2.27% higher than that of a diluted 200 stocks, less frequently, semi-annually rebalanced portfolio. Researchers Lesmond, Skill, and Joe, 2004, questioned the momentum premium's affordability, claiming ad hoc assumptions of trading costs make the profits illusory. Korachik and Sacker raised similar concerns in the context of the marketing impact costs and estimated that the capacity of momentum strategies is limited to around $5 billion. In a rebuttal, Andrea Frazzini, Ron Israel, and Toby Moskowitz analyzed over $1 trillion of live trading data from AQR. They found that the estimated transaction costs used in prior research were possibly 10 times higher than real-world trading costs, and that momentum profits are robust to transaction costs. The debate continues with Fisher, Shaw, and Titman, 2015, assessing the trading costs of momentum strategies as somewhat smaller than those estimated by Lesmond et al., and generally much larger than those reported in Frazzini et al. The consensus from the academic community seems to be that momentum profits exist net of transaction costs, but their scalability is limited. To sum up, a clear relationship exists between portfolio construction, holding periods, and momentum profits. The transaction costs are always an important factor to consider when implementing any active strategy. Here are the 2 key takeaways from the research covered in this section. For any given momentum portfolio, the shorter the holding period, the higher the annual growth rates. For any given holding period, the smaller the number of firms in a portfolio, the higher the annual growth rates. At this stage, we can safely conclude this chapter by saying that the momentum factor clearly satisfies all our criteria. We should therefore consider it for our machine learning constructed portfolio. But we must briefly discuss one last topic before progressing to the next factor.